Good guys, let's step it up a few notches. Cool Traders assume a VAT rate of 15%. Cool Traders is a registered VAT vendor that sells air conditioners. The entity has a 28 February financial year end. Cool Traders accounts for inventory by using the perpetual inventory system, and they maintain a profit margin of 30% on cost. Now let's just stop the bus right there. What does that mean? Maintains a gross profit percentage or profit margin of 30% on cost. So if we write cost, that is the cost price of a product, then obviously we add a profit to the cost price of the product, and what do we get then? Then we get the selling price of a product. So if our policy is to maintain a profit margin of 30% on cost, it means that if my profit is 30%, then it means that my cost must be 100. 100 plus 30, because 30 divided by 100 equals 30%. You agree? That's not selling price, it's supposed to be selling price. Okay, so what is my selling price then? It's simple. 100 plus 30 equals 130. So keep this in mind. We're going to use this, and you're going to use that a lot this whole semester. So the sooner that you understand this little formula, the better for yourself. The VAT control account had a credit balance of 42,800 as at 1 February 2013. It's a credit balance, so that means they owe the receiver of revenue that amount of money. And then the following transactions for February has not yet been recorded, and they want you to provide the journal entries to record the transactions for February. Journal narrations are not required, and assume that all parties are registered VAT vendors unless otherwise stated. All amounts include VAT where appropriate. Good. Let's see what happened on the 1st of February. A check was issued for 7820. If a check was issued, it means that we've made a payment of 7,820 Rand to Nashua in respect of the rental of the entity's photocopier for the next 6 months. 1st of February, we pay the following 6 months. So it will be February and then 5 months in advance. Remember that our year end is 28 February, so we cannot account for prepaid expenses in our expense accounts. We must defer that into an asset account. The rental contract stipulates that the monthly rental increases by 20% on 1 April each and every year. So it is important in the first place that you understand exactly what you're reading. They have paid rent on their photocopy machine 6 months. The first month of the 6 months is February. The financial year end is the end of February. How many payments was in advance? 5 payments. What is the payment? We don't know. But what we do know is that the rent increases on 1 April every year. So for the months of February and March, so it's 2 months, we are going to pay a certain amount of rent. We don't know what it is, so we just put in X, right? Then that's February, March, April, May, June, July, 4 months. What are we going to pay then? We are not going to pay an amount of X, but we are going to pay an amount of 1.2X because we have escalated our rent with 20%. Right. Now in total, we have paid 7,820, but that obviously include VAT. Now in accounting, before you start making any computations, you get rid of the VAT. So if we get rid of the VAT, we say, well, our VAT exclusive amount equals 6,800 Rand, being 6 months payment. Included in that 6 months payment is 2 months at the normal rent and 4 months at the escalated rental of 1.20. So grade 1, let's escalate it a little bit. Grade 3 maths. We can write this in a formula. Do you agree? So we say in our formula, oops, let me just get to the right place. In our formula we say, okay, still not there, just hang in. 6,800 equals 2 months, February and March, rent at X, plus 4 months, total 6 months, 6 minus 2 is 4 months at an escalated rent of 1.2x, and the total being 6,800. Grade 3 maths then, I can actually find the value of x. I only have one unknown in this whole formula, so x equals 1,000 rand. 1,000 rand then is our rental for when? For February and March. February is the current month, so that is the month I'm going to expense. So I'm going to debit my rental expense, statement of profit or loss, remember the statement indication, 1,000 rand. Then what did I prepay? March, which is also 1,000 rand. April, May, June, July is 1,000 times 1.2 times 4 months equals 4,800 rand. So my total prepayment being 5,800 rand. So prepaid expenses, statement of financial position, 5,800 rand. What is the VAT that was included in this payment that I made? Guys, it's 6,800 times 15%. That is our VAT. So that VAT we can claim. Now listen very carefully. What does the receiver of revenue tells us? The receiver of revenue tells us that there are two things that's important that is going to indicate whether VAT is going to play a role in a transaction or not. He says if there is a VAT invoice, so the first question that you ask yourself is, was there a VAT invoice? If the answer is yes, then you can claim the VAT as per the invoice. If the answer is no, the second question that he asks you is, did cash flow take place? If the answer is yes, he says, then you may claim the VAT. Did cash flow take place? Yes, we issued a check, so cash flow took place. So he says, well, included in that amount that you paid, you can actually claim the VAT portion of that amount. Okay, that's 6,800. So 6,800 times 15% equals the VAT. So the VAT that we can claim, 6,800 times 15% equals 1,020 rand. So VAT input, statement of financial position, 1020. And then obviously bank will be credited with the full amount that we've paid, 7,820. So let's quickly recap. What does the receiver of revenue ask you if you want to know whether you can claim VAT or not? First question is there a tax invoice? If the answer is yes, he tells you claim the VAT on the tax invoice. If the answer is no, he says, okay, well, did cash flow take place? If the answer is yes, he says, so then it's fine. You can claim the VAT, which was included in the cash flow that took place. So that was the first thing. So the VAT exclusive amount, 6,800, was for a 6-month period, of which only 1 month was in the current month, or in the current financial year. 5 months was in the next financial year, and that portion of the payment has to be deferred. We can only expense and defer that exclusive of that figure. Why? The VAT isn't ours. We have claimed the full amount of VAT in any event when the cash flow took place. So whatever the remaining amount is, that is ours, and that we have to work with. Guys, in my income statement, no item, listen carefully, no item in the income statement includes VAT. Everything excludes VAT. no asset, no liability, no equity accounts include VAT except the following. Bank and cash will have VAT inclusive amounts because that's the actual cash flow that took place. Debtors, the debtors control account will be VAT inclusive because that is the amount that the debtor has to pay us. The creditors control account will be VAT inclusive because that is the amount that we owe the creditors and that is our commitment that we have to honor. And then obviously the VAT control account is the VAT portion which we actually have to pay or receive back from the receiver of revenue. But that's all. All other assets will be VAT exclusive. All other liabilities will be VAT exclusive. And equity, everything there is always VAT exclusive. So remember that. That is extremely important. On the 3rd, inventory was purchased on credit from Unitherm suppliers. A tax invoice for 46,000 Rand was received. If I have a tax invoice, I can claim the VAT. It's a perpetual system, so I'm going to debit inventory statement of financial position 40,000. If you have said purchases, no marks for that whole line item. A periodic inventory system, you will have purchases, but in a perpetual inventory system, you will have inventory. Then you can claim the VAT, which is included in the 46,000. So 46,000 divided by 1.15 gives us 40,000. That is our inventory amount. 40,000 times 15% equals 6,000. That is the VAT that we're going to claim. VAT input, statement of financial position, and then creditors control with a full invoice amount, 46,000. Creditors will always include VAT. Debtors will always include VAT. Cash and bank will always include VAT. And that is about the end of the story, except for the VAT control account itself, or the VAT accounts themselves. Sold air conditioners to a local supermarket for 25,415 cash. So that was the proceeds that we received from selling those air conditioners, which is obviously VAT inclusive. So we have to take out the VAT. We have received 25,415. Cash flow will always include VAT. What can we recognize as sales in the statement of profit or loss? The VAT exclusive amount, 25,415 divided by 1.15, 22,100. What is the VAT that we have to pay over to the receiver of revenue? We're going to credit VAT output with 22,100 times 15% equals 3,315. But this is a perpetual inventory system. And in a perpetual inventory system, we have to update our inventory records with each and every transaction that has an impact on our inventory. So if we have sold inventory items, it means we don't have that inventory on hand anymore, so we have to make an adjustment in the inventory account. They don't give us the cost price of the inventory items, but what they do give us is our profit formula. First things first, we say we cannot work with something that includes VAT. So what is our selling price of the stuff exclusive of VAT? 22,100. If we want to convert that into cost price, we can, because cost plus profit equals selling price. So what do we have now? We have the selling price now. So if we want to work back to the cost price, it's quite easy. So 22,100 multiplied by 100 divided by 130. And that equals cost price of the goods which was sold. So if we're going to do that calculation, 100 divided by 130 multiplied by 22,100, our sales figure, that will give us a cost price of goods sold, 17,000. So we will debit cost of sales 17,000 and we're going to credit inventory 17,000. Let's assume for a moment that we have sold these items after we have given the customer a discount of 10%. So This 22,100 that we've recorded as sales is not our normal selling price. That equals 90% of our normal selling price. Now guys, if I want to apply my normal cost formula, I first have to convert my sales figure into a normal sales figure, because this is what happens normally. Normally the selling price equals cost 100 plus 30% profit on the cost. That is what happens. So if I now for some other reason decide to deviate from my normal way of calculating my selling price, I must adjust somewhere, either the selling price to a normal price, or I must adjust my formula. Now I promise you it's much easier to convert your selling price, your actual selling price, to a normal selling price than what it is to try to convert this formula. It's not wrong, but you always make mistakes with that. So rather take my advice. First thing, before you're going to work out the cost price, you're going to convert the 22,100 into a normal selling price, and then you apply your normal 100 divided by 130 of the normal selling price in order to arrive at the cost price of the goods sold. Issue the check to settle the amount owed to Unitherm suppliers. Now remember that's a 46,000. Now obviously that is only to settle this outstanding bill, this creditor of 46,000. So if I want to settle that account, I have to debit that account to get it out of the books. So I'm going to debit creditors control statement of financial position 46,000. I'm going to credit bank statement of financial position 46,000. Remember, if you don't give me the statement indication, no marks for that whole line item. Okay. Next one. Bought equipment from KM Stores for 3,200 Rand cash. This entity is not registered for VAT. So KM Stores is not a VAT vendor. Will KM Stores ever be able to issue a tax invoice to us? No guys, they can't, because you have to be a VAT vendor in order to issue a VAT invoice. So that means if they can't issue us a VAT invoice, can Cool Traders ever claim any VAT on that transaction? No, because they're never going to get a VAT invoice. Going back to the remarks that I made about cash flow and invoices, the cash flow will only be applicable to claim the VAT if I have transacted with a VAT vendor. If I haven't transacted with a VAT vendor and there can never ever be a tax invoice issued, then I will never ever be able to claim any VAT on a transaction. So with that specific person or supplier. So KM Stores will never be able to issue us with a VAT invoice, therefore I cannot claim any VAT on that. So my equipment, the cost price of my equipment is going to be the full amount paid, 3,200 Rand. Equipment statement of financial position, 3,200. Credit bank, 3,200. I have purchased from a non-VAT vendor, therefore I cannot claim any VAT on that transaction. On the 22nd, received 805 Rand from Andrew Mitchell in respect of repairs completed on his air conditioner. Andrew is not registered for VAT. Great. Does that make a difference? No, guys, there is inconsistencies in the VAT Act if it actually suits the receiver of revenue. It says you are not allowed to claim VAT if you make a payment to a non-VAT vendor. It says, but I don't care whether you sell goods to or deliver services to non-VAT vendors. You are my last port of call. So whenever you're going to receive anything which is income-wise or it's going to increase your bank account, that means that is an item which is subject to VAT. So it doesn't matter whether Andrew Mitchell is registered for VAT or not. It says regardless of that fact, part of the 805 Rand is my VAT that you have to pay over to me. So the fact that I'm selling on to a non-VAT vendor makes no difference whatsoever. The receiver of revenue wants his pound of flesh and he says, give me my money. So we received in our bank account 805 Rand, but the income we can recognize can only be the VAT exclusive amount, 805 divided by 1.15, i.e. 700 Rand. Then we have to pay over the 105 Rand included in that amount that we've received as VAT output to the receiver of revenue. Paid salaries of 85,000 Rand cash. There's no VAT applicable on salaries. So salaries expenses, 85,000 debit, statement of profit or loss, bank statement of financial position credit, 85,000 Rand. If you did check to settle the VAT due at the beginning of the month, SARS levied a fine of 20% on this amount since payment was late. The fine was also paid. So the VAT control account had a credit balance of 42,800 at the beginning of the month. We were supposed to pay it earlier on. We didn't. As a result of that, he added 20% to that amount as a fine. And he says, now you have to pay me everything, and that was also paid. Good. So the VAT control account, we're going to clean out 42,800 Rand. The expense account, VAT penalties and interest, is going to be debited statement of profit or loss with 8560, and the 8560 is 20% of 42,800. And bank would have been credited with a full amount of 51,360, the balance plus the interest. You could have done this in a different way as well. You could have done two journal entries. You could have debited the VAT penalty expense account, 8560, and credited the VAT control account, 8560. And then you must have debited the VAT control account with 51,360, and you would have credited the bank with 51,360. At the end of the day, both of them are correct. They achieve exactly the same end result. The owner takes inventory with a selling price of 1495 for his own use. Now, the first thing that we are interested in is that we don't have the inventory on hand to sell anymore. Inventory is shown in our books not at sales prices, but at cost prices. Now, the first thing that we want to do is always, before we can do anything with anything in accounting, 1495 divided by 1.15 will give me the VAT exclusive amount, 1,300. Now we can start working with that. 1,300 equals the VAT exclusive selling price of an item. If we want to adjust our inventory record, what do we have to adjust it with? With a cost price. Can we convert the selling price into a cost price? Yes, we can, because we have our normal profit formula. There it is. Times 100 divided by 130. That gives us the cost price of that goods of 1,000 Rand. So that is our inventory value that we have to adjust. Now, what happened when we purchased that inventory initially? We bought the inventory. The amount that we've paid for the inventory was 1,150 Rand. 1,000 Rand cost price plus VAT of 15%, which is 150 Rand. So we paid for those inventory items that the owner took now, 1,150 Rand. What did we do then? We claimed the VAT input of 150 Rand. So our initial entry was debit inventory 1,000 Rand, debit VAT input 150 Rand, and credit bank or creditors, depending whether it was for cash or not credit, 1,150 Rand. So the receiver says, well, I have allowed you to claim that 150 Rand at the date that you purchased this inventory items. And the reason why I allowed you to do so is because your intention was to sell that inventory items on which you're going to make a profit, and then based on the selling price, you would have paid me VAT output on the proceeds for those items. He says, but you cannot longer sell those items because you have taken that items for your own use. Therefore, I want my money back. I want my 150 Rand back that I've allowed you to claim from me initially. So 1,000 times 15% equals 150 Rand. So that means we have to pay the receiver 150 Rand back. Here's a long story how to get to the 1,000 Rand. And now we say, well, inventory, statement of financial position, credit, 1,000 Rand. We're going to have to pay back the 15% that we originally claimed on the 1,000 Rand. The cost price of the items purchased at that stage is 150 Rand. So our drawings is a total amount of 1,150 Rand. Statement of financial position. Drawings is not an expense. It is statement of financial position. A debtors account with a long outstanding balance of 2,875 is being written off. Guys, what was our initial entry when we recorded that? We said sales debit with, let me just put it in a different color. We said sales, not sales, debtors, with the invoice amount, debit with 2,875. We said credit sales with what? With a VAT exclusive amount of 2,500. And then we said credit VAT output. So we paid the receiver of revenue the difference of 375 Rand. So this was the original entry. Now, this guy has never paid me, and he is also not going to pay me. I cannot do anything about the sales because that's sales I have recognized already. But I'm going to write off my debtor to 2,875. But what about this VAT output of 375 that I paid over to the receiver of revenue initially? The receiver of revenue says, look, I'm not an unreasonable man. So therefore, I know that you've never received the money, never collected the outstanding debt. Therefore, you are out of pocket with that 375 Rand that you initially paid over to me, and therefore I will allow you to claim it back now. The only thing is that I'm not going to debit sales because that is not correct, but I'm going to debit another expense account called credit losses, not bad debts, credit losses. Listen carefully. I don't understand bad debts. I only understand credit losses. So I'm going to debit an expense account credit losses, statement of profit or loss, with a VAT exclusive amount of 2,500 Rand. I'm going to claim back the VAT that I've originally paid over to the receiver of revenue. So VAT input, 375. Guys, the golden rule is if I debit a VAT account, it's input. If I credit a VAT account, it's output. And then I'm going to credit my debtors account in order to clean out that original balance, that debit. I'm going to credit it now so that I can take it out of my books. So debit an expense account to 500, debit VAT input 375, and credit debtors with 2875. An old machine with a cost price of 23,000 and accumulated depreciation of 8,000 Rand is sold for cash to Pete Smith for a VAT inclusive amount of 18,400. Now, remember when I bought this asset initially, this machine, the receiver of revenue allowed me to claim VAT on the purchase price. So that means whenever I'm going to sell that asset, the receiver of revenue says, don't get too excited because although you received 18,400 Rand for that machine, only 16,000 Rand is yours. The difference between the two equals VAT that you have to pay over to me now. Okay, so with that in mind, let's follow the steps that we're supposed to follow when we dispose of a non-current asset in our books. The first step is check whether we used the asset in the current financial period. If so, provide depreciation for the current period. Why only for the current period? Because the rest of them will already be there. The second one is remove the cost price of the asset out of our books. The third one is remove the total accumulated depreciation, inclusive of the current year's depreciation, out of our books. The fourth thing is record the proceeds on the sales transaction. And the last thing is, just move a little bit, as you can see, balance of the asset disposal account and record profit or loss on the disposal. Let's go through it one by one. The first step is, did we use this asset in the current year? If the answer is yes, then the next question is, have we provided for depreciation on that asset for the current year? If the answer on that question is no, then you have to pass the depreciation on that asset for the period that you've used that asset in the current financial year. Remember, the previous financial years will be lying, if the depreciation for previous years is my accumulated depreciation account. Remove the cost price of the asset. Now here you're going to use an asset disposal or asset realization account. Remove the total accumulated depreciation out, again, asset disposal or realization account. Record the proceeds, again, in the asset disposal or asset realization account. And balance of the asset disposal account and record the profit or loss on the depreciation. You don't have to make use of an asset disposal account. You can skip that. But take my recommendation and make use of this. Especially in the second semester, we're going to do cash flow statements. And if you don't understand the working of the asset disposal account, you are fairly screwed. So let's follow the steps. This cost price of this asset was 23,000. The accumulated depreciation was 8,000. So let's have a look at the calculations. Cost price 23,000, accumulated depreciation 8,000. So the carrying value of this asset at the date of sale 15,000. This 8,000 was at the date of sale, so we don't have to provide for any depreciation in the current financial period. Proceeds. Remember what I said to you about the proceeds? The portion of the proceeds of 18,400 that belongs to you is only 16,000. So we received 16,000 for assets in our books, which is stated at 15,000. So obviously we received more, so we made a profit of 1,000 Rand. So let's follow the steps. Take the cost price of the asset out of the books. Cost price, asset's got a debit balance, so if I want to take it out, I have to credit that account. Statement of financial position. Debit my asset disposal account, 23,000. Credit my machines at cost account, statement of financial position, 23,000. Then that one is out of my books. I've transferred that balance to the asset disposal account. Second step, take the accumulated depreciation out of my books. Accumulated depreciation is a negative asset, so therefore it's got a credit balance. It reduces the value of the asset. So how do I take it out? I debit the accumulated depreciation account, statement of financial position, and I credit the asset disposal account, statement of financial position, 8,000. What is now lying in my asset disposal account? The carrying value of the asset of 15,000. Next step is record the proceeds on the sale of the asset. How much have we received for this asset? Guys, we received in our bank account 18,400 Rand for the asset, of which I am only allowed to recognize 16,000. So our asset disposal account will be credited with 16,000, and the difference between the two will go to my VAT output account, statement of financial position, 2,400. So now I have accounted for that transaction. Now we have to clean out our asset disposal account. The purpose of the asset disposal account is to calculate the profit or loss on the disposal of the asset. That is the reason why we do an asset disposal account. Now, when we're going to balance that account off, you will see that you need an entry on the debit side of that account in order for it to balance out. And that would be, we're going to debit the asset disposal account with 1,000 Rand, statement of financial position, and the counter leg will be posted to an income account, statement of profit and loss, profit on disposal of the asset, 1,000 Rand.